Welcome back. Earlier this week, it was reported the median existing home price declined 3.1% from a year ago. That was at a level of 396,100. That's the largest year-over-year price reduction since 2011, December. This is what they're referring to. The blue line represents the median sales price of existing home, again, currently at 396,100. They're comparing, this is a year-over-year report, so the compares May, this is a report is from May of this year, to May of last year, May 2022. And if you go back in time, we can see May of 2022, it was all the way up here. The reason why many economic numbers, especially housing numbers, are reported on a year-over-year basis and a seasonally adjusted year-over-year basis is because the housing market is very seasonal. Sales tend to pick up over the summertime and slow down over the winter for various reasons. But this does represent the largest decline since going back to 2011, which is significant. Now we're going to take a look at a number of figures where we're going to see a very positive look at the housing market as well. Here we see a median sales price of existing homes, which over the long term continues to rise, as does the single family home sales price. That's in red, and the yellow histogram bars in the background are interest rates, the federal funds rates. Now we know the Fed paused during their last meeting. The Fed has been raising rates to combat inflation. Now the reason why also that these housing numbers are so important is because it's believed that the Fed will resume interest rate hikes. And one of the reasons to compel the Federal Reserve to do so would be higher housing prices. We see here the inventory, active listings, the number of listings continues to rise compared to the XHB, which is the housing market ETF, the index, the exchange traded fund, which basically mirrors the price of a number of different housing stocks all put together. The stock market's been strong, and no surprise, this has been going up. There's a positive correlation, at least at the moment, where we see the inventory is starting to tick to the upside. Now, if the housing market gets very strong, then we'll see inventory start to fall. That means that there's so much demand out there that there's less homes for sale, but we actually see a tick up in the inventory. Here's the inventory price per square foot. Now, as inventory declines or has declined, I know last month it rose slightly, but over the past few months it has declined. When there's less inventory out there, the price per square foot tends to rise, and we see that very much holds true and has a very strong correlation to the XHB, the housing market home builder stock index. The green line in this case is the price per square foot versus active listings in orange. Active listings goes up, the price per square foot goes up. All of these numbers look, quite inflationary. The prices are going up, the number of listings are going up. Well, the number of listings aren't really going up as much as the price per square foot. That, I would say, overall is inflationary. Here we see the sales price for the single-family homes is rising over the past few months since hitting a bottom January 23. Here's the issue. We thought going back to January that maybe the higher interest rates as a result of all the Federal Reserve hikes were starting to take effect and the sales price was going down. The sales price is starting to go up. Maybe that tells the Federal Reserve they need to raise interest rates further. That's, I think, the message from a lot of these charts. Here's the median sales price, what was reported most recently. I know on a year-over-year basis it's declining, but on a month-over-month basis, it looks strong, and it continues to go up along with the XHB, the Housing Market Index. Here's the XHB laid over the federal funds rates. Both tend to go up. Eventually, the XHB is going to start to falter if we continue to see higher interest rates. We had a pause this past month, and that really shows us that the XHB may have further to go, because if the housing market stocks were going up in light of higher interest rates, the expectation for their earnings will probably be even better now that they've paused for 6 weeks. Here we see existing home sales monthly supply. The supply is going up, and this is one of the few numbers that is maybe not so positive. Why is the supply going up? We thought there was a lot of demand out there. See, the prices are going up, but the supply is also going up. Are the prices going up because they're keeping pace with inflation, but yet the supply is also going up because there's just not the demand? Maybe that is the case. It's a very interesting dynamic we're seeing here. Usually we don't see, I don't think, the combination of rising inventory and rising prices. After all, if it's a strong market, inventory should be falling. Here's inventory that looks like it's rising also alongside the XHB, but the XHB I think is more driven with the broad market indices like the S&P 500 and the Dow. Here's housing market, the median inventory median days on the market, which declines. We're now at levels that we have not seen 43 days on average. We have to go back to August of last year. Be interesting as we approach, we're in, but more into the deep summer months. This should continue to decline because there is overall faster activity during the summer months. Here's the days on the market alongside interest rates. As interest rates rise, the days on the market also rose, but now they're falling. This, again, this is a bullish signal. Now, last but not least, we take a look at the Affordability Index. This is published by the National Association of Realtors. It measures the degree that a typical family can afford the monthly mortgage on a typical home. Now, a value of 100 means that a family with a median income has exactly enough money to qualify, exactly enough income to qualify for a mortgage. If it's above 100, that means a family has more than enough income. Less than 100, less than enough. Well, the affordability index is in red. And again, the rising line shows us that the average family can afford the average home based on their average income. This is the 100 level. We were above 100, we're 104, going back to January, 103 in February, looks like just below 100 March, 96.2 in April, and the most recent report, 96.2 in May. And that brings us back to levels we haven't seen since December of 22. And that's over compared with the XHB, the stock markets, housing market index, I should say. And we see a pretty strong correlation. Both go down together, both go up together. Notice the stock market, specifically the XHB, is going up without the affordability index. And I think this last chart really gives us the most amount of insight that while we see mixed messages, we see, the headline report is that the existing home sales price is the steepest decline year over year basis, May to May, since 2011. Okay, well, that's bad. We see the inventory is rising. That's not so good either. But then we see the prices overall, they're still trending higher. And that's good. And then, of course, we see the XHB, the housing market stocks are going up. Well, let's take the stocks and put those aside. That we can discount those stocks being very strong as a result of rising markets overall. So they may be, falsely strong. The positives, we see rising prices. But rising prices, I don't know, maybe that's tied more to as a result of inflation, as a result of a weakening dollar, as a result of all of the spending and, interest rate hikes, etc. But then we see the inventory that's not really rising, and that's kind of bearish. But overall, the affordability index, at the end of the day, the market is what we as consumers can buy, what we can afford. And this affordability index is not as positive as some of the other numbers. So I think this is a mixed report. It's going to be interesting to see what the Federal Reserve takes away from this. If they look at the headline inflationary number, well, maybe they'll be compelled to raise interest rates. If they take a look at the headline, existing home sales, the biggest drop since 2011, maybe they'll be more inclined to pull back. But this is just one element. We have jobs, we have CPI, manufacturing, we have a lot of different components overall. And of course, we have the bond market. That's going to give us a special insight to this as well. But we'll continue to watch all these numbers very carefully, and we'll be sure to update you along the way. We hope this has been helpful. We look forward to seeing you back soon.